Good evening. I'm John Kelly, publisher of the Orlando Medical News, Central Florida's primary source for professional healthcare news. Understanding the impact of November 3rd on healthcare and managing to our mission, it's my privilege to introduce your host, Randy McGaha with Tax Savings Professionals. Welcome, Randy.
Thank you so much, John. I really do appreciate that. I appreciate all that you and your team are doing for the medical professionals here in Orlando area, as well as the entire state and beyond. And I'm certainly glad for our partnership as well. Good evening. I am Randy McGaha, and welcome to Tax Saving Professionals, Trump versus Biden, what you need to consider on November 4th. Today's format will be a panel discussion between Tom Gibson and David Babinski. Now, you may not be familiar with these two gentlemen, so let me take just a couple of moments for introductions. CPA Tom Gibson is the senior tax strategist at Tax Saving Professionals and has over 30 years experience in public and corporate accounting. Tom, you want to take just a few moments and introduce yourself to our listeners here this evening?
Yeah, absolutely. Pleasure to speak with y'all this evening. As Randy said, my name's Tom Gibson. I have been in accounting for over 30 years at this point. I've been licensed as a CPA in Tennessee since 1991, and I also have a license here in Florida as well. Spent about 12 of those 30 plus years in public accounting, just tax and audit, CPA firms. Moved over to corporate accounting and held CFO and vice president of finance level positions with a couple of different companies. I always loved tax planning. Whether it was in public accounting or on the corporate side, I think the reason that I enjoy it so much, if you're doing a good job at it, more often than not, you're getting to give people good news about this situation. And 9 years ago, I relocated to the beach here in Florida. At this point, I prepare one tax return per year. I still do my own, and honestly, I'm thinking about letting somebody else do that one this year. So again, good to talk to you. Looking forward to this evening.
Thank you, Tom. I really appreciate that, and we certainly appreciate you being with us here this evening. We also have David Babinski. He's the Director of Business Development of our real estate affiliate, True North Resources. David has 27 years experience in investment advisory, deal strategy, due diligence, and capital raising. David, you want to take a moment and say hi to the folks here this evening?
Sure. Thanks, Randy. Thanks, John, for having us. Like you just said, for 27 years, I've been a student of the tax code. I kind of have a little saying, we try and put together strategies, not tactics. So it all comes from the perspective of an overarching financial plan. And, with the True North affiliate of the Tax Saving Professionals, we focus on the real estate deals. There's a lot of nice tax nuggets in real estate, and, it really resonates with me. So that's what I enjoy doing, and it's good to be here tonight.
That's great to have you with us as well, David. It's great to have both of you, and I appreciate the time that you're here, that you're putting into this evening to be here and be able to help with this discussion. So in our discussion this evening, we'll cover the central parts of each tax plans, Trump's and Biden's. We will examine each through two case study examples. We will cover what you might consider now and what to consider on November the 4th, the day after the election, in case of a Democratic sweep. Now, if you have any questions as we go through this discussion, please use the question and answer, the Q&A feature, not the chat, to submit your questions, and we'll do our best to answer each and every one of them. So, gentlemen, shall we start with an overview of each plan before moving into a few examples?
Yeah, absolutely. So let me preface our discussion with just a little bit of background. With President Trump's plan, it is far easier for us to present that, mainly because what the president wants to do is simply extend the provisions that have been in place since the end of 2017 with the Tax Cut and Jobs Act. Little nibbling around the edges, but for the most part, you can summarize President Trump's plan by saying he wants to make some of the provisions that are currently temporary, they sunset in 2025, some of those provisions in the Tax Cut and Jobs Act permanent. Vice President Biden's plan is a little bit more amorphous at this point. We don't have legislation. It is in many ways a return to tax law prior to the Tax Cut and Jobs Act. In doing these examples, I've had to make some assumptions because, for example, we don't know what the tax tables would look like under a Biden administration. We know roughly what the rates are. $400,000 is a number that pops up over and over and over in the former vice president's proposal. And so there's a little bit more guesswork. Now, that being said, everyone on this call has their preference regarding the election. And the host and panelists are included in that statement. We have gone out of our way to fairly present both plans and the impact that those plans could potentially have on your tax situation going forward. So let me share my screen, and we'll begin with President Trump's plan, which again is basically the law that we've been operating under for 2018, 2019, and 2020. One change that the president has proposed is to drop the amount of indebtedness upon which you can deduct mortgage interest. Right now, the limit is $1 million. They're talking about lowering that to $750,000 of mortgage indebtedness. Doesn't mean you can't have a mortgage larger than that. It only means that you can only take the mortgage interest deduction up to that point. The corporate tax rate now is a flat 21%. There are a number of changes in the Tax Cut and Jobs Act that are temporary. And again, the president would like to see some of those become permanent. The charitable contribution deduction, with just a few very minor alterations, would remain as it is now. Unreimbursed medical expenses that are taken as an itemized deduction. Currently, they need to exceed 10% of your adjusted gross income. So if a person made $500,000 per year, they would be able to deduct their medical expenses once those exceeded $50,000 or 10% of AGI. There are certain miscellaneous itemized deductions that are currently suspended. The one that folks most often make use of is the moving expense deduction. I mentioned that there are some things that will go away at the end of 2025 if Congress doesn't act. There are also some things that will come back at the end of 2025. Alimony payments are not deductible beginning in tax year 2019. There have been some adjustments for traditional 401k contribution limits for folks who are age 50 and older. There is a temporary raising of the estate tax exemption for single filers, and the Section 179 deduction, which if you're a business owner, that's what allows you to write off equipment in a lump sum as opposed to depreciating it over a number of years. That deduction cap has doubled, and the phase out limit has been raised as well. So that essentially is the Trump plan. David, any comments?
No, I think you really covered a lot of it. You know, how Congress works is the 2017 Act had a lot of, you know, short-term, this will sunset. And the thought is as political power is accumulated, that can then be made permanent. And that's really the gist of this plan. You know, all the things that are already on the books but are set to sunset after 2025, they just want to make those permanent. So there's not a lot of surprises here at all.
Right, absolutely. Now the Biden plan is a little bit more, as I said, up in the air at this point. And there was a question. I'm going to field this one, Randy.
Okay, good. I was getting ready to ask you that. Thank you.
Yeah, the corporate tax rate is the C corporation tax rate. That's absolutely correct. So the Biden plan is a little bit more fluid at the moment. One change that we know is afoot. There is currently a limitation on the amount of W-2 wages for an employee, and that could be in an S corporation or just a W-2 employee. There's currently for this year $137,700 cap for purposes of the FICA tax. The Biden plan is going to keep that cap in place. I'm sure it'll be indexed a little bit for inflation. But so between $137,700 up to $400,000, you wouldn't pay FICA on those wages. But once your W-2 wages go above $400,000, the FICA tax comes roaring back. If any of you on this call have sole proprietorships, Schedule C businesses that you report on your personal return, that same provision would be in effect for you as well if you're paying self-employment tax. The top individual income tax rate, and again, this is an assumption that it would pick up at about $400,000. That would go back up to 39.6%. Long-term capital gains rates and qualified dividends would be taxed at 39.6%. but incomes above $1 million. Now that is a substantial change. That is basically a doubling of the long-term capital gains rate if your income is north of $1 million. This is an absolute sea change. We're going to talk about another provision that we have seen in the code on and off since the Clinton administration. But the capping of the tax benefits of itemized deductions at 28% of their value is something completely new. We make use of a number of strategies, one of which we're going to discuss a little bit this evening, that basically wipe the income out of those higher brackets. That would no longer be the case, or at least it wouldn't be able to be used to the same extent under former Vice President Biden's plan. Dollars that normally we would be knocking out in the 39.6, the 35, the 33% brackets, we wouldn't be able to do that any longer. There would always be some residual tax left in those upper brackets. And so again, this is something completely new. The P's limitation is what I was alluding to a moment ago when I said this is something that was in during the Clinton administration, out during the first Bush administration, came back under President Obama, left again with the Tax Cut and Jobs Act. And basically it's a phase out on itemized deductions. You begin to lose the value of some of your itemized deductions once your income crosses a certain threshold. Again, for purposes of tonight's discussion, we're assuming that that's going to be around $400,000. There would be an elimination of the state and local tax cap. Currently, the maximum amount that you can deduct for state and local taxes is $10,000. That would disappear. Now, that doesn't make much difference to a lot of us here in Florida because we don't have state income tax. My clients in New York and California, this has been a sore point since the passage of the TCJA. And they're kind of a little bit excited about this. Well, let's not get excited too soon. We're going to run through the numbers, and that elimination of the cap is not quite all it's cracked up to be. There would be a phase out for the qualified business income deduction. That's what QBI stands for filers who have taxable incomes above $400,000. Now, for healthcare professionals, as well as for attorneys, CPAs, financial planners, the qualified business income deduction has been a little bit of an illusion. It's in the code, but in order for you to take advantage of that, we have to get your income into very tight parameters. Now, there's a way to do that. We do that on a regular basis with our clients. But I have clients who also own say, a manufacturing company. They are not subject to those same limitations currently. Under Vice President Biden's plan, everyone would be capped on the availability of the qualified business income deduction, which, to go back to our question that was asked a moment ago, was really to kind of try to equalize the playing field, since the C corporation rate dropped to a flat 21%. The QBI deduction was an attempt to kind of normalize that for folks who have S corporations. And of course, it also applies to partnerships and sole proprietorships as well. There would be an expansion of the earned income tax credit for workers over age 65 who do not have children. There would, and this is kind of a fixture in most tax plans that the Democrats put forth, there would be renewable energy related tax credits. There would be an increase in the corporate tax rate from 21% up to 28%. And there would be an elimination of this. This is more of an estate tax issue, and I'm going to ask David to comment on this further. There would be an elimination of the step up in basis that we currently have under estate tax law. So David, a lot of folks on the call may not understand the implications of that. Could you unpack that a little bit for us?
Yeah, sure. It's actually the cornerstone of a lot of strategies and a lot of planning that has gone on for, for decades, 40 plus years. There's a provision in the code called a like kind exchange. Sometimes they call it a 1031 exchange, where if you had a corporate office building or, really any property, and you exchanged it for a like kind following some specific rules and timelines and deadlines, you would inherit the basis into that next property. And the main benefit of that is, you kind of roll it until you go, and at death, titled properly, it would step up in basis, meaning your beneficiaries would then have that property at the then fair market value, and then they can start their ownership chain of that the same exact way, depreciate, transfer, and do that. This basically torpedoes, generations of tax planning with the stroke of a pen. And it's really not, and I can't remember if one of the next slides talks about the estate tax exemption, but couple that with, the sense of security a lot of our clients feel that they can pass 11.48 million per person to the next generation through their estate. You mentioned Bill Clinton before. I came into the business when he was president. And back then the estate tax started, or the exemption ended, however you want to say it, at $600,000. So that's the value of your house, your business, your assets, your IRAs. Anything over 600,000 used to be taxed. Well, Congress and the powers that be have wrestled with that over the decades, and now that's 11.48 million, and it's per person, and it's really off of everyone's radar. Well, part of this plan is to then reduce that to the 5 million it was before the Tax Cut and Job Act, and there's even some whisper number at 3.5 million where you would have to start to pay estate tax. So this is a real game changer. I'm sure we'll mention it in a bit, but the debt is going up so quickly. They've got to get the money from somewhere, and really, high income earners and, folks that are dead are the best places for them to get it, because there's not many other places to get it. So yeah, really keep a close eye on this step up. That is a game changer for, anyone with real estate, especially. With stocks, same thing, right? You can leave stocks, you'd get a step up. So any asset that's appreciated is now fair game in the estate tax.
All right. And then in addition, there would be an $8,000 tax credit that could be used for child care. And there would be an equalization of tax benefits, particularly when it comes to defined contribution retirement plans. Many of you probably have, and you may know it as a cash balance plan. That may be the terminology that your pension administration folks use, but a number of our clients utilize those. And there would be an elimination of the real estate industry tax loopholes. Now, I'm not a fan of the term loophole. It sounds pejorative on the face of it. One man's loophole is another man's opportunity. I don't know any business owners who got to be involved in writing the tax code, and we certainly didn't at Tax Saving Professionals. We just get to help folks apply it to their best advantage. And there would be an expansion of the Affordable Care Act premium tax credit. So we're going to take a look at a couple of different scenarios, and we're taking a business owner here who, in the first example, makes $850,000. They have probably $200,000 of that would be W-2 income, and $650,000 that's passing through to their personal return from their business. They have itemized deductions of, I have to revert to my spreadsheet here to make sure I tell you the right numbers. They have itemized deductions of about $80,000. Of that $80,000, $27,000 are charitable contributions. And so we're going to run through this. Before we get to the numbers though, implicit in these illustrations is a strategy that we use with a number of our clients. And I baked them into the numbers because we had originally done, David, was it 2 or 3 webinars for our client base on this material. And our clients are familiar with this. I know a number of you tonight would not be. And so I want to give you the 2 or 3 minute explanation. In a lot of ways, this strategy is indicative of the type strategies that we like to use with our clients. This is found in section 170H of the Internal Revenue Code, and it has been in the tax code since December of 1980. And so this is Jimmy Carter era tax law. In December of 1980, I was within 5 months of graduating high school. So it has been around for a long, long time. And I wasn't held back or anything. You know, we love to use things that have been in the code for a good long time because they just give you so much additional information about how to take a deduction properly, because now you're not just dealing with the code and the Treasury regs, you've also got tax court cases and revenue rulings, IRS field notices. All that additional information just helps you stay well within the black letter of what the code allows. Section 178 deals with an opportunity that came into the code really in light of the building boom in the Sun Belt in the late 70s, early 80s. You had a tremendous amount of migration of folks and a lot of businesses relocating to the Southeast and Southwest, not just because of the sunshine, frankly, because of the tax climate as well. And with that influx of folks, there was a lot of building, commercial building. Of course, folks had to have places to live. Children had to have places to go to school. Roads had to be built. So a tremendous amount of development going on. Congress looked at what was happening in cities like Atlanta and Dallas, Fort Worth, and Phoenix, and they became concerned about overdevelopment. And so they placed some incentives in the tax code to encourage folks to at least consider conserving property permanently. And there are some criteria that have to be met. Obviously, it needs to be property that has development potential. And secondly, there are some conservation requirements as well. You can't just place any piece of property you want to into conservation. There are 4 basic values that have to be present there, at least one of them, for this to work. But it's pretty easy to understand. We've got a piece of property that is owned by an individual or by a group of individuals in a partnership, let's say. And that property is worth a certain amount of money just as raw land, but it's in the right place, it's ripe for development, and that property could be developed, and obviously developed, it would be worth more than it was just as raw land. The projects that our clients have participated in for about 4.5 years have actually been based on mineral rights. So think of it as a piece of land that, say, has granite underneath it. The land is a certain value, but the real value actually is that granite, which could be mined and sold over a number of years. The return as an investment typically would be about 4.5 times a person's capital buy-in. And so I put in $1, and over typically a 20 to 30 year period of time, as that granite is being quarried and sold, I would make my $1 back, and I'd make about $4.50 on top of that. And that's not a bad deal at all. And the fact that it is a good deal actually opens the door to another possibility. The partners could vote to conserve that piece of property. Now, if they do that, there are going to be restrictions placed on that land that would, in this example, prevent that granite from ever being mined. And this, again, is in accord with that almost 40-year-old provision here in about 6 weeks in the Internal Revenue Code. If they do that, though, they're going to get to take a charitable deduction, not based on what they paid for the property, but based upon what they'll be giving away forever by conserving the property. So that 4.5 to 1 return that they would have earned becomes a non-cash charitable contribution that typically can be taken in a single year. So I said all that, and we certainly would be more than happy to talk to you more about that. I gave you, I said the 3-minute version, but it turned into 5. But I wanted you to kind of understand that because it is in the numbers that we're going to take a look at. Now, there's not really any significant change as to how adjusted gross income is computed under either plan. And again, in our example, we're using $850,000. Now, with the itemized deductions, again, we're taking into account the $80,000 of itemized deductions under both scenarios, and we'll talk about the limitations. And we're adding to that the proposed charitable gift. Now, with this particular strategy, in conjunction with an individual's other charitable giving, you can utilize this to wipe out up to, if the math makes sense, 50% of their adjusted gross income. So in this example, we had $27,000 of charitable contributions, and so we're trying to push up to that $425,000 limit under both plans. Now, this is a little bit counterintuitive because in our example here, this individual had $35,000 of state and local taxes. So they don't live in Florida, probably, but they had $35,000 of state and local taxes. So why did our itemized deductions only go up by $11,500? Well, welcome to the Pease Amendment. This individual at $850,000 would immediately lose $19,500 of their overall itemized deductions right out of the gate. And so now under President Trump's plan, of course, the current law, they're going to lose $25,000 due to the state and local tax cap already. So they're getting it under the Biden plan, and it's being taken away. And the net impact is that under the Vice President's plan, your itemized deductions would be $11,500 higher than they would be under President Trump's plan. But as I said a moment ago, that elimination of the state and local tax cap is not quite all it's cracked up to be because of that Pease Amendment adjustment. And so the qualified business income deduction under the current law, this individual would be able to take about a $38,480 qualified business income deduction. That's that 20% pass-through deduction on business income. Under Vice President Biden's plan, that would be completely phased out at this point. So we'd be left with taxable income of $358,520 under the current law and $385,500 under Vice President Biden's proposal. So the taxable income would be $26,980 higher ultimately under the Vice President's plan than under the current law. Now, $27,000 is nothing to sneeze at, but in the bigger scheme of things, on $850,000 of adjusted gross income, it's not a terribly large number. But the differences in the plans come to the fore when we actually start to calculate the tax. Because under President Trump's plan, the current law, the tax bill on that $358,520 would be $76,757. Under the Biden plan, same roughly, the same income, the tax bill would be $143,498. Now, why such a stark difference? Well, it's because of how the tax is calculated. Remember a moment ago, I mentioned that itemized deductions are capped at 28%. So once an individual's income goes above the 28% bracket, which I'm estimating that will be at about $233,000 of taxable income. And basically, I just went back and found an old 2017 workbook and kind of use that to do the projections for the Biden plan, because the Pease Amendment was built into that. But in this individual's case, at $850,000 of adjusted gross, we're left with residual tax in the 39.6% bracket. Even after our itemized deductions, we still have $36,285 of tax in the 39.6% bracket, $3,780 in the 35% bracket, and in the 33% bracket, we wipe out a good bit of it, but again, we're capped. We've got $25,450, and that is with itemized deductions wiping out all but about $58,000 of the income. So it is a very, very different way of calculating the tax bill, and it's not just because of this charitable contribution. It's any kind of itemized deduction that you lose the benefit of. So the marginal tax rates here, and this is a little bit deceptive, and David, you may want to speak to this in just a moment. If you look at this, the person's marginal tax rate's only gone up from 32 to 33%. Now, let me explain a little bit, because I'm using inside baseball terms, and marginal tax rate, that is the tax rate that you're paying on the last dollar that you make that year. In other words, that's your top bracket. Now, this is a little bit misleading because of that residual tax that we still have in this example in those brackets above 33, but technically this person's topping out at the 33% bracket. But again, there's another number that I pay an awful lot of attention to, the effective or the average tax rate. So marginal tax rate, that's what I'm paying on the last dollar I make that year. The average tax rate, that's what I'm paying on every dollar that I make that year. And so under President Trump's, the current law, this person's effective tax rate is 19.5%. Under the Vice President's proposal, it would jump up to 27.4%. And this presupposes, in both examples, that there would be an investment into a real estate project of $89,000, and it further assumes that the partners would choose the conservation route, and that's where large non-cash charitable contribution comes from. So David, feel free to weigh in here.
Yeah, let me see if I can kind of convert the CPA speak into English. You know, when you
Do you want me to talk slower with that?
No. When you look at the headline, it's going to say, marginal tax rate only 1% higher, on the wealthiest among us. And for the most part, that is absolutely a true statement. But as, Tom was going through point by point, it's the magic is happening under the hood here. Absolutely. Right? You're taking deductions, but you're not getting the full benefit of that. You're paying income tax gradually as your income goes up, but then you're being hit from the other side with these surcharges and these reductions. So it's almost like a squeezing effect. Tom mentioned we've given similar presentations already, and I was talking to one of our clients who's he's a specialist, and he basically said, I don't have to work as hard. If I'm going to make an extra dollar and 60, 65, 70% of it's going to not be mine. He said, I have no desire to work that hard. And I think we're going to talk maybe a little bit about the unintended consequences, but I wrote a couple of things down here just to give some takeaways. If you make over 400,000, you're been singled out your target. I mean, that's where a lot of this is going. And then, we'll talk about the next example. I think if you make over $1 million, you're a bigger target. The capping of the deductions is the big thing. And then, it goes on to say that, according to the Tax Policy Center, Biden's tax proposals would increase revenues by $4 trillion over 9 years. And 93% of that is going to come from the top 20% of wage earners. So, this is when they say they're not going to raise tax on, on the middle class is what's been reported. For the most part, that math checks out. So yeah, marginal tax rate, it's only 1% higher, as your tax almost doubles that you have to actually send in and pay. So it's proposed, it's not law, a lot can happen, kind of on the way to get this all in there. But as Tom said, all he simply did was took out the 16 or 17 workbook and punched the numbers in. This is, kind of what the code was when Pease was still there and the deductions were phased out. So,
yeah, the big changes of that capping of itemized deductions, that is what is accounting for all of the difference, just about in this illustration. And that's something, as I said, that is completely new. We've never had to deal with that before. All right, so let's take a look at a second example. Same numbers as last time with one exception. We've tacked on a $200,000 long-term capital gain. And so that's really the difference here. Now, because adjusted gross income is a larger number, then we would essentially, for tax planning purposes, be thinking about a larger limit for charitable contributions. And so under this example, you see, though, the reason I wanted to point this out, on the previous slide, there was $11,500 difference between the Trump and Biden plan. The Biden plan was higher. Biden plan is still higher, but now only by $5,500. And again, why? Well, we're back to that Pease amendment limitation. We're losing, as the income goes up, the phase out goes up as well. And you're losing more and more of your itemized deductions right out of the gate. The QBI deduction would be, for folks who are in specified trade and businesses in any event, would be gone under either proposal. So we'd be left with taxable income under the Trump plan of $497,000, under the Biden plan, $491,500. So an absolutely minuscule difference in taxable income. But look at the tax bill. Under President Trump's plan, it would be $107,000 and change. Under Vice President Biden's proposal, it would be bumping up against $197,000. And again, the difference is twofold here. One, that $200,000 long-term capital gain, instead of paying $40,000 under the Trump plan, you would now be paying twice that amount, $40,000 under Vice President Biden's proposal. Plus, we would have a further capping of the itemized deductions. We'd have more dollars being taxed in higher brackets. And so the difference, again, between the two plans is about $90,000. The marginal tax rates, the difference here becomes more stark because even with the $200,000 long-term gain under the current law, the top tax rate is still 24% because that long-term capital gain is only being taxed at 20%. Under Vice President Biden's plan, the marginal rate would be 33%. And again, even that is a little bit misleading because we've got that residual tax in the upper brackets. The effective tax rate, again, this is a good way to compare these, as good a way as any. Under President Trump's plan, 20.8%, Vice President Biden's plan, 29.3%. And both examples assume $111,000 buy-in to a real estate investment, and again, assume that the partners would vote to conserve the property. So David, I'm going to stop sharing here so we can see each other a little bit better. There we go.
You know, I'm going to just kind of go out and say that hopefully, you know, a lot of these proposals that we're basing these calculations on are, you know, simply to get some headlines, because it really does box in the high income earner. I said before, 93% of this supposed, you know, increase in revenue is going to be borne by the top 20%. Well, 75% of it is going to be borne by the top 1%, because here's what's happening. As your income, you know, we talk about this all the time. The tax code is really just a series of incentives and I guess disincentives. And look at what this example is talking about. All right, long-term capital gains are no longer distinguished over this income limit. So now you're going to pay ordinary income. Well, it's going to change the ripple effect of this is going to be almost immeasurable. Then, oh, well, why don't I max out my 401k? That's going to be limited. That's that equalization, your bullet point. That's going to be limited to 28%. So even though you're putting money in to this deferring retirement plan, you don't get to deduct all of it under this plan. So you're getting squeezed from that end. And oh, by the way, you owe an extra 12.4% on Social Security over 400,000, but your Social Security is not going to be a penny higher. It's just a surcharge. It's just a grab. And that's what I was alluding to before. I think that, you know, productive individuals that are making these high wages are going to decide that their time is worth better than 28 cents on the dollar or whatever the number ends up being. And their capital is better spent elsewhere than a long-term project that could give them some tax benefits. And that's what I'm saying. It would almost be hard to fathom a tax code where every incentive to save, to invest, to work is, you know, being throttled back. I just think, you know, in the guise of fairness or however it's being cast, I do think that, you know, it would be tough for all of this to come to pass. But this is how it's written. Tom and I both studied this. We agree with this is how it would be, you know, calculated if this were to come to pass. But I really didn't want to kind of ramble, but, you know, again, if I make $1 and 68, 72, 78 cents of it's going to go somewhere else, I have something better to do with my time. I don't know, Tom, what else was in there?
Well, I mean, and you hit the nail on the head, David. I mean, the tax code really, it's not necessarily just about collecting revenue. It certainly is about that. But to a certain extent, it's about doing exactly what you said, disincentivizing certain types of behavior, incentivizing other types of behavior. And, you know, the way that I always think about this, many of you on this call, your homes are paid for. Your children's education is taken care of. You've set aside money for retirement under the current regimen over the last however many years you've been contributing toward your retirement. And I want to put this as diplomatically as I possibly can. Anyone who thinks that tax policy does not affect the way that people run their businesses is an idiot. I mean, that's the kindest way I could put it, because it does. And what David is talking about, I have actually lived long enough to be around and see in action. I've seen people who had the ability to drop back to 3 days a week, and their lifestyle, didn't change appreciably. They didn't feel like they were being taken to the cleaners on that extra money they would have made. And so overall, they're probably not hurt too bad. The folks who are hurt are the people who work for them, who can't afford to work 3 days a week. They need to work 5 days a week. They've got bills to pay. And so it's a very difficult situation. David hit, and I probably should have said this at the outset. If we had a clean sweep in the election and the Democratic Party controlled both houses of Congress and the White House, the tax law is not going to change the day after the election. So we are not saying, run out and make a bunch of knee-jerk reactions to something that may happen. That's not what we, are recommending at all. But there definitely would be some things to think about were that to be the case. And so, David, let's maybe shift gears here a little bit and talk about, well, first of all, before we do that, though, anything else just on the estate tax side that you want to mention, and then we'll kind of talk about takeaways from this.
Yeah. So, there's lots of different types of inflation, and we're not going to get into, how the economy works, but basically anyone who keeps their balance sheet, and you have any type of assets, you can see that, the value of money is decreasing. And there's lots of ways to measure that. But basically what I'm saying is fast forward 7 years, 14 years, 21 years. And I'm doing it that way because if your assets are earning 10%, they're doubling every 7 years. And then start to think about a $3.5 million estate tax exclusion, and then a 50, 55, 60% tax over that number. And you could start to see some of the projections that we see with our clients that there's going to be a lot of money that's potentially lost as it transfers from generation to generation. So, Tom hit the nail on the head. Like, don't run out tomorrow and start making all these massive sweeping changes, but certainly the opportunity is to take a step back and look at your overarching plan. It doesn't matter what's going on in politics, have an idea of what the plan is. And then these type of facts and figures just, might lead to some tweaks in an overarching plan. But some, maybe some takeaways years ago. And Tom, you've had experience with these when I mentioned the $600,000 estate tax exclusion. Now it's 11 million, the family limited partnership. Absolutely. Right. We used to do a lot of discussions about access and control is superior to ownership when, you still have the asset, you still control it, but you might own 1% as a general partner and your, family owns the other 99% as limited partners, but it's not going to pass through your estate at, about 1% of the value. That's a strategy. We can start teeing up discussions with our advisors now, and then talk about November 4th and be ready to do things, because even though the estate tax could drop, you still have the ability now to shift that 11.4 while you're alive into, quote unquote, outside your personal estate. So there's some planning opportunities there that will just vaporize. I mean, it's just one of those things, people tend to do nothing and time just keeps going by. And, I don't know exactly what the saying is, but, if you don't know where you're going, any road will get you there. Just like keep on keeping on. But this is certainly an opportunity to focus for one point in time and say, where do we want to get to? What decisions we spend a huge amount of our time on Roth conversions. They can someday do away with the Roth provision where your retirement account is growing, tax deferred like all your other, but then when you take it, there's no taxes due. Well, even if they change that, our code gives us this historical perspective of something called being grandfathered in. So we're spending a lot of time right now running strategies on doing Roth conversions. And that may change on November 4th on how quickly we accelerate that. But we've got just about every one of the people we talk to on some type of a Roth conversion discussion, if not a hard and fast strategy. That's something you could be doing, again, regardless of the political climate. have your money accumulating in a tax advantage bucket is the analogy I use. And then it doesn't matter as you get into retirement, as the winds blow one direction or the other, you're going to be in this tax advantage environment when the time comes. So that's really the invitation here, is to take stock from a big picture standpoint of what type of strategy are we going to follow for retirement, security, and legacy. So I don't know. I know we have a little bit more to cover, but that's really, for me, the opportunity always is to do a little bit of a big picture planning. And now as these new pieces of information come in, it becomes more clear, what you need to do because you have a plan.
Yeah, and David, I just want to clarify one thing, because a lot of folks on this call may have been told by their CPA or their financial advisor, well, you make too much money to contribute to a Roth IRA. So could you just unpack, when you say a Roth conversion, explain what you mean by that?
No, I'm glad you picked up on that, because we're in it every day. We forget about that, but I do hear that from time to time. Oh yeah, talked about it. I make too much for a Roth. And that is a true statement to contribute to a Roth. If you're in a 401k plan at work or and you make over a certain, 200 and whatever thousand, yes, you cannot contribute, your $6,000 to a Roth. But everyone under the current code, regardless of income, can convert to a Roth, meaning if you already have money inside of a retirement plan, it's already growing tax deferred, you can convert. Now it's a taxable event, right? You're going to have to pay tax this year, next year, however you do it. But think about this. If you've got $1 million for a round number, and you're 50 and you have to take it at 72. So let's say 3 doubles, right? I'm making a bunch of assumptions. I'm doing math in my head, but if you're making 10% on your money and it can double, well, let's just say 7%. If you make it 7% on your money, it'll double in 10 years, right? So $1 million grows to 2 million, 2 million grows to 4 million. And now you're forced to start taking it out in retirement, required minimum distribution. You owe tax on all 4 million. Right? That's not your money. You've got a joint owner called the government. You just don't know what percentage they want to take. Well, the Roth conversion would allow you to convert that million to a Roth right now. Yes, you have to pay tax on whatever percentage of it you convert. But now as it grows from $1 million to 2 and 2 to 4, you'll never have to pay tax again. So the analogy that we use is, would you rather pay tax on the seed that you're going to go out and plant, or you'd rather pay tax on the harvest once it's multiplied and multiplied? And that's just an easy way to remember that. But Tom, you're absolutely right. So many people say, oh, I'm not eligible for Roth. And not only that, on the conversion, you are eligible for what we call a backdoor Roth. So even on top of the conversion, you can get money into a Roth given the right strategy. It's a 2-step strategy to make a non-deductible traditional contribution and then convert that. But yeah, the Roth, I'm not saying it's the end all be all, but boy, I've probably worked with 1,500 to 2,000 people in retirement, transitioning to retirement. That's how I got started in the business so many years ago. And having that pot of tax advantage money accessible to you in retirement could make all of the difference in the world. Because whether you know it or not, retirement is not an asset problem. Retirement is an income problem. How much money do you have to live on? Replacing your job with some other source, and an income problem is a tax problem. So, when you take it from that perspective, some of these strategies become more clear, and the cost of getting into a Roth becomes more palatable, because you can actually see the benefits of it as you get into retirement, and the flexibility it gives you. I say this a lot too. Retirement is a string of one-time unexpected expenses. And it's nice, especially if you have kids, by the way, and it's nice to have access to some type of tax advantage money if you need an extra 10 or 20. I had one client years ago, they needed $50,000 to help bail out one of their kids. They needed to take it from the retirement account, but then they needed to take 65 so they could cover the tax. And then when they did the calculation of taking 65, they needed to take 72 to cover the tax. And then of course their Social Security was surcharged the next year because their income, and now they need an extra 500 a month. I mean, it's just like, you just cannot imagine if 100% of your net worth in retirement is in a tax deferring account, you're almost, that's where this term, oh, I'm on a fixed income, because you don't have the flexibility. So here's the opportunity to do some planning and look at some strategies that are going to have long-term implications for you, for retirement, and for your legacy.
Absolutely.
So to your point there, just a little bit there, David and Tom, one of the questions is, is this going to affect anything in 2020? On the 2020 returns, is anything, say there is an administrative change, Is any of these things going to be put in place for 2020?
No, I don't think there's going to be any significant tax legislation between now and the end of the year, regardless of who wins. Because obviously the inauguration wouldn't take place until January of next year. Anyway, the new Congress wouldn't be sworn in. Although now I say that kind of tongue in cheek, because if you were listening closely when I talked about Code Section 170H, it became law in December of 1980 during a lame duck Congress. And so it was after Reagan had won the 80 election before he took office. But so there may be some things like that, but I don't think there's going to be anything significant, and certainly not the proposals that we've been outlining. Those have to go through Congress. So,
all right, thank you. So, how about planning? So, obviously, what would be? We talked a little bit about the retirement. Would there be any other steps that would need to be taken, say, almost immediately to prepare for whatever happens in November 4th?
Yeah, you want to take that, Tom? I think it's just,
yeah.
I'm just going to repeat kind of what I already said. You know, use this as an opportunity to talk with your estate planners, long-term asset protection, which should be a part of everyone's plan anyway. But there are some opportunities through various vehicles, some that we might have to dust off from these prior, administrations where, assets can be shifted out of the ownership structure that they're currently in, but they can be maintained with the control structure they currently have. And that would utilize, see that I keep mentioning, and again, 27, 8 years of kind of doing this, everyone knows what that's like it's just kind of second nature. But when you have this exemption, whether you die or prior to that, of 11 million that has to be kind of spent, well, if they change that number and move the bar and you didn't take advantage of it, you lost it. But right now you can take advantage of that given the proper advice, and then it's grandfathered in. So, if you're worried about having an estate over 3.5 million or say 5 million, which is where the code is set to revert back to anyway, you may as well be looking at these type of strategies now. And then, you have a plan A if the election goes one way and a plan B, but still do the planning in light of the estate tax. I have so many people that just say, oh, my estate plan is to just blow it all and, leave the kids nothing. And that's that. And that's all well and good. But sometimes it doesn't pan out that way, with various life expectancies. And it's nice to at least have something written down on what we'd like to have happen. So Randy, the answer to the question for me is it's never too late to plan, have something in mind. What do you want to do? Get some advice from people who do this. And there are some strategies out there that can be executed prior to knowing who wins the election. It doesn't matter.
Thank you, David. Appreciate it.
Yeah.
All right, well, Tom, David, listeners, we're coming up on our time. And so I want to thank you for your participation. And there's certainly much to consider. So before we leave, David, any parting thoughts?
It's going to be an interesting one to watch because it's got to, obviously the election's got to happen, then the negotiations need to happen, but we have absolutely no visibility on who's going to be doing that negotiation. I'll let Tom talk about that. So that's, troublesome as this, any changes, whether it's now, 4 years from now, 8 years from now, someone somewhere has got to pay for all of this debt that the country is going into. And, there really is only a couple places that revenue can be extracted. So I'm more concerned about the disincentives. We didn't talk at all about the corporate tax. There's, sweeping proposals on corporate taxation, but really what is a corporation other than employees and executives and customers? Someone's going to have to pay this, along the way. So it's, the micro adjustments to our plan as time goes on, and just this, 5-year, 15-year, 100-year plan that you keep your North Star, and then you kind of tweak it along the way. So the opportunity here is to just use this as kind of a wake-up call, if it needs to be called that. But what should we be doing? Let's not just keep our head down and just keep working, plowing money into a retirement account. And then before you know it, you have this massive tax time bomb that no one even alerted you that, in your particular tax, but maybe that's not the best place to put money. And I think if they do that surcharge we talked about, if that comes into play, this will come into more focus. Because if you don't even get the full deduction on the front end, why in the world would you let it accumulate and have a full taxable event on the back end? I think there's going to be sweeping changes to our industry, and I just hope that everyone takes a moment here to plan and at least take stock of where you're at.
Yeah. Thank you, David. We appreciate that, and appreciate your participation here this evening and in this discussion. And Tom, any parting thoughts before we leave?
Well, yeah, just real quick, three things to keep in the back of your mind. And David brought one of these up, so I'm just going to mention it because we've talked about it a great deal amongst ourselves. I'm old enough to remember when the Obamacare law passed. As you recall, and we talked about, what do you do if there's a clean sweep and Democrats control both houses of Congress and the White House? We don't have to look back too far to have an example of that. And the legislation, the kind of centerpiece that came out of that was Obamacare. And I want you to understand, again, I'm not trying to frighten you. I'm not trying to, keep you up tonight. But if that occurred, you need to understand that the negotiations will not be between the Democrats and the Republicans if the Democrats don't need the Republicans to pass legislation. And the converse would be true if the Republicans were to retake the House and President Trump, retain the White House. So the negotiations on this could potentially be between the Clinton-Biden wing of the Democratic Party and the Sanders-Warren wing of the Democratic Party. And we've been talking about 39.6% top marginal rates. There are folks calling for significantly higher rates than 39.6%. So understand that, first of all. Secondly, in a lot of ways, until we get some clarity on the election, a lot of our conventional tax planning, year-to-year tax planning, is kind of turned on its head. Normally, what you want to do is to defer income and accelerate expenses. This year, if we have a change, that might turn everything on its head, where we're trying to accelerate income into 2020 and pay tax on it at a 37% rate, or particularly if it's a long-term capital gain, pay tax on it at 20%, as opposed to paying tax on it at 39.6 next year if we defer action. And again, we'll have good 6-7 weeks to kind of sort that out, and as David said, to do some planning. My other concern would be the reaction of the stock market, because folks, we've had a pretty good ride, even with some bumps and ups and downs with market, and the markets will react regardless of who wins. So again, I don't mean this in a pejorative sense toward Vice President Biden at all, but there will be a reaction, and the depth and the broadness of that reaction nobody can calculate, but it's something that, again, just needs to be part of your planning. Unfortunately, by the time it happens, there won't be a lot that can be done about it. And so if you've got some gains, you might want to talk to your financial professionals about maybe just locking that in this year for a number of reasons. So, but I'm not a licensed investment advisor. I'm just a country CPA. So you need to talk to your advisors about that.
Well, thank you, Tom. I appreciate that. And I certainly appreciate your participation here this evening in our discussion. And just as a layperson, I just wanted to mention just a few of the takeaways that I gathered from our discussion here this evening. And I think number one, the numbers tell the story. And I think we can see that certainly from the illustration, from the examples that Tom and David mentioned here this evening. And number two, I would encourage each and every one of our listeners, you've got to have a plan. And if you don't have a plan in place, then let tax saving professionals help you to be able to get that ready, because time is flying by and it'll be here before we know it. And it's always important to have that plan in place, as has been mentioned here this evening. And then number three, I want to encourage each of our listeners to go out and vote. I know it's a great opportunity that we have, and this is your chance to put your voice in. So make certain on November the 3rd or before that you place your vote. So if you have any additional questions, anything that's been mentioned here this evening, or anything that even came up during the conversation that you would like more information on, you can contact me, and you can contact me directly at 772-257-7947, or email me at randy.mcgahey@taxsavingpros.com. And my contact information is on your screen now. So I want to say a special thank you to John Kelly and Orlando Medical News, and to our participants here this evening, and each of you as listeners for all of your time here this evening, and have a great evening.